Hello and welcome to the Adansonia Capital Global Opportunities Portfolio Update for April 2026. This is our disclaimer. Please read it at your leisure. To move forward, I will take it as read. So April 2026 was a strong month for the portfolio where it returned 6.66%, outperforming the MSCI World Net Index in Aussie dollars. After a fairly strong rotation out of growth equities over the last quarter, we saw the market basically start to reconnect to fundamentals, recognizing the intrinsic value of the growth shares that we own, and also that these shares also basically returned strong earnings results through reporting season at the moment. Over the month of April, nothing was traded. We currently have 15 shares in the portfolio and around 3% cash. So for this month, I'll just touch on our view of the 2026 Australian federal budget. The subtitle basically says it all: Liar, Liar, Australia on Fire, a high-level view of betrayal and wealth destruction. So the Albanese government bought votes funded from the private sector to backdoor tax changes that arguably would have been voted down at an election. At least in 2019, Bill Shorten had the integrity to basically bring his war on franking credits to the market, to the voters, where it was voted down at the election. This has been a tax reform, if you can call it tax reform of this sort, has been a veiled agenda for the Albanese government for quite a while, and they've now basically shown their true colours. While the government calls it tax reform, there's no reform here. The budget is basically lazy and stupid, and it's nothing more than a tax grab where tax rates are lifted on all capital assets. This budget will not achieve the main stated aim of rebalancing the housing market. Actually, the opposite. So it doesn't take an economics graduate to work out that if you tax an asset class, it's not going to basically promote supply or investment in that asset class. If this is not going to basically deliver additional housing, and furthermore, in terms of discouraging people away from housing, it's going to reduce the supply of rental properties and push up rental prices. The younger generation with this budget was apparently targeted. Literally losers like the rest of us. They've had the incentives to build a home deposit via shares taken away. So effectively, where the government, I should say, the Prime Minister and most of his front bench have enjoyed the benefits of being able to negatively gear and enjoy the 50% CGT discount on capital gains. That's essentially being taken away from the younger generation. And effectively, given that these changes apply across all asset classes, particular shares, that is going to hurt the younger generation, where a lot of the younger generation are basically investing in the share market to try build a deposit or enough money to basically move into the housing market. The winners, from what we can see, is obviously the federal government with an increased tax take, immigrants, or basically migrants moving to Australia to settle, which is running above stated targets, and the Victorian state government. So essentially, one incompetent Labor government basically feeding an incompetent state Labor government, which is moving to an election in November this year. We've seen by the recent Victorian state budget that there is no desire to pay down any of the interest. The budgets are still in deficit, and it's just giving the Victorian state government a war chest to try and basically buy votes for another term. The losers of this budget are pretty much everybody, from what we can see. Every Australian investor, small business. And this is the thing, the attack on family trusts. You see every small business, from the guy that's mowing your lawns to tradies, plumbers, they all basically have their business owned through a family trust. And that's been basically attacked. So small business aspiration or aspiration of any kind, we'll talk about it later in this presentation, but why you invest in this country now is basically beyond our understanding. And the Australian economy, which is going to essentially be negatively impacted in the sense that if you're destroying the wealth of the people within the economy, you're destroying the economy. Interesting to see that almost all of the stated NDIS savings, a lot of which are just trying to rein in the rorting, plus the tax grab will be used to fund the expanded government and public service. Around 98%, I think, of these monies will basically go just to fund and run the bureaucracy of the government, the big government. The disincentive for private sector investment, as we spoke about before, will simply reduce economic growth and reduce employment growth. So what we're seeing at the moment, we believe that the change at the margin for the Australian economy moving forward, or these changes are implemented, will be negative. As we mentioned before, the budget remains in deficit. Immigration levels, which are running at ridiculously high levels, currently, I think over 1.4 million. The population of Australia under the Albanese government has increased by over 1.4 million. By 2030, we are basically targeted, I think, to have around 30 million people living within Australia. More than 80% of that change or that growth will be through immigration. These people basically come in, they need housing, they buy goods and services. Immigration is inflationary. Government spending, which is basically debt-fueled and running beyond our means, is also inflationary. Net zero, where essentially we are saddled with higher energy costs, are all inflationary, and all of these key policies continue to pressure inflation up, which is forcing the Reserve Bank to basically raise interest rates. Even though I can't see how the Reserve Bank raising interest rates, which basically punish the consumer and the private sector, will do anything to discourage homegrown inflation through government spending. Anyway, with all of these issues, worryingly, debt to GDP in Australia will rise, and effectively the numerator, the debt, will continue to increase, while the denominator, GDP growth, will decrease. The Australian economy is a Ponzi scheme of debt-fueled government spending and mass immigration, both of which are unsustainable, as any good Ponzi scheme is. Again, the Australian economy, from where we see, is incredibly fragile, and these tax changes are only going to basically make it more fragile or more vulnerable. Immigration levels, as we've spoken before, have kept Australia from a technical recession. I think 10 of the 13 last quarters, though, on a GDP per capita basis, have been negative. And now, at the margin, with these changes and essentially disincentivizing investment, question mark is whether or not we actually will move into a technical recession. Even if we don't, as we mentioned before, the quality of Australian economic growth is very poor, all being funded or fueled by immigration and big government. So what does this all mean, essentially, with respect to investing in Australia and I guess the Australian share market? Well, very simply, Australia, on all levels, income, capital, etc., we have uncompetitive tax rates on a global stage. Our energy prices are uncompetitive, labor costs, interest rates, our regulation levels are ridiculously high versus the rest of the developed world. And also, further to that, you see that the rest of the developed world, in most particular America, they continue to strive to make business conditions more attractive to attract capital. And this is what this government does not understand. Capital is mobile. Basically, capital will go to where investors get the best treatment. And over the past 5 years, Australia has seen more business capital leave the country than basically come to the country. We've been a net exporter of capital, and essentially these tax changes will only see more capital flow out of the country. Big government and negative productivity gains has capacity constrained the Australian economy and largely crowded out the private sector, which has been basically brought to its knees. And now, with a very inefficient economy, lacking in any form of productivity or productivity gain, circa 2% growth in Australia is now seen to basically be inflationary. And very simply, the Australian economy will be left behind the rest of the world moving forward. The rest of the world will continue to grow, especially the United States will continue to grow at a far faster rate than what the Australian economy will. Further to that, what we've seen, especially in the reporting season, is the strong Australian dollar due to the interest rate differentials with the RBA fighting homegrown inflation. There's been a headwind for Australian corporates with overseas earnings. And once we see the RBA get back in cycle with the rest of the world, where essentially the rest of the world has been easing or is in hold or potentially been hawkish with the outlook for interest rates, whereas we've basically hiked now 3 times, we believe the Australian dollar and the US dollar will collapse, basically, which will reflect the basic size and outlook for the Australian economy and the US economy moving forward. And while the market is worried about the debt to GDP levels of the US economy, what we're seeing is the nominal growth rate of GDP in the US moving forward will be higher than that of the interest rate of debt in the US economy, and also the budget deficit in the US is now basically back to pre-COVID levels, essentially with the reining in of government spending and the reining in of waste. So while the US debt is high, the outlook for where that's moving, we believe, is a lot more promising than what's going to happen with respect to Australia. So what does it all mean? Well, essentially, the ASX 200 is a barometer for the Australian economy, and essentially under the Albanese government, it's returned a miserable 4% annualized capital return over the past 5 years. What we saw last week was a CBA result. It might be the canary in the coal mine. The CBA, after its result, basically fell over 10% on the day, where it's essentially delivered a weaker than expected result. And we've spoken about, I guess, a challenge for the Australian banks to grow credit in this environment. And further to that also, what we've also seen is that there's a record level of people that are behind in their loans since COVID in Australia. And also to that too, CBA was the world's most expensive bank. So a lot in that share price, which was basically deflated a little bit, but it is still no bargain on in an international context. So a higher tax burden, and we're talking about capital, but also bracket creep. So essentially, inflation is actually good for the government, because if people get a pay rise to try and meet the negative impact of inflation, that higher level of income basically gets eaten up by bracket creep, by basically moving to a higher tax bracket. So essentially, a higher burden on your capital gains, a higher burden on income gains, on top of the government exacerbated cost of living pressures, which I mentioned before, the debt fueled or the homegrown inflation. Essentially, we had an inflation problem before the Middle East conflict. Wealth in Australia is declining. Further to that, also what we've seen, especially for the younger generation, these mooted tax changes, I shouldn't say mooted, these delivered tax changes will push people to preference income over investing in capital, basically push people to put money into the banks, into term deposits. Essentially, to generate wealth, you need to generate more than inflation. And we just don't see that this is a good backdrop for creating wealth. So what does it mean? Essentially, as I mentioned before, we believe there's an opportunity, and obviously for our product, which is a global equity portfolio, investing in the best businesses we can find around the world, in the best economies in the world, developed economies. We believe there's an opportunity here to use a very strong and overvalued Australian dollar to considering investing in better companies operating in better economies that support business, and just to sort of diversify, I guess, your investments out of this country, where effectively this government is doing nothing to basically promote or incentivize investment in capital investment within Australia. Anyway, I wish I had better news, but it is what it is. So we shall see. Anyway, thank you for your time. As always, Tony and I are available for a chat. Our contact details are on the bottom right of the slide, or otherwise you can catch us on our inquiries line on the website, www.adansonia.com.au. I look forward to being in touch in a few weeks for the May 26 update.